Hello everyone, and welcome to this edition of the NZX Virtual Investor Event. My name's Oliver Logan from the Capital Markets Origination team here at the Exchange, and we're hosting today's event. Today we're lucky to have two speakers from across our listed issuers. First will be Brent Pattison from Oceania Healthcare, followed by Dr. Hartley Atkinson from AFT Pharmaceuticals. Before we kick in, we'll just do a quick little housekeeping. So the format is a 10 to 15 minute presentation followed by a Q&A. Feel free to send any questions that you have through in the chat, and we'll try to make sure that we get through them all live if we can. Just to confirm, this is obviously a recorded session, so it will be available after the live session is concluded on YouTube. And just a general disclaimer that none of the content is financial advice and should just be considered general information. So first up, we have Brent Pattison, CEO of Oceania Healthcare. Welcome, Brent. Brent's a qualified chartered accountant and has had many senior finance roles across the sector in New Zealand, including investment banking experience and across the healthcare sector and aged care. So well positioned to talk to us about Oceania and where you're heading. So Brent, I'll hand over to you and be back shortly with Q&A.
Excellent. Okay, thanks, Oliver. Welcome, investors. We've just come off the back of our interim results, and it's an interesting time in the market. So very pleased to kind of address you today. If we could maybe go to slide 1, that would be helpful just for context. So if we think about Oceania, for those people that are familiar, I'll just give you a quick thumbnail sketch of it. We're a New Zealand and Australian listed business. We were formed back in 2005, and from my perspective, Oceania is a great place to work. We provide critical infrastructure and essential services to over 4,000 residents every day, and we have a large labour force. And you'll see us in most towns and cities as you travel up and down New Zealand. So we're nearly at 50 sites up and down New Zealand. We're as far south as Christchurch, and more recently as far north as Northland or in Whangarei. What makes our business a fantastic place to work is the many activities that exist within Oceania. So Oceania is more than just a single business. At our essence, we're here to provide best-in-class resident experience to older people in New Zealand. And we do everything from transportation to meals to activities to communication to community to medication to technology, but at our essence, we're really about connection and well-being for our residents. So in that sense, we're a very large services business, but we're also an accomplished design, delivery and construction business. We build about 300 residents every year. We have a pipeline that has about 2,000 consented units and care suites ahead of us over the next coming years. So a very large construction business, and that's been fascinating during sort of supply chain disruptions. And lastly, we're a very large people business. We nearly have 3,000 staff, 2,900 to be exact at last count. And all of our staff come from all sorts of different walks of life. So we have kitchen staff, we have healthcare assistants, we have a professional labour force in the form of a corporate office, registered nurses, clinical directors, business and care managers, etc. So it's a very diverse, broad labour base. And the last thing that we are is an innovative business. So there's a lot of things that we've been doing in the sector as we reimagine what residents of today and what residents of tomorrow actually require from us. It is a fascinating business to work in. Like I said, it's all of what you'd expect in a services business. It's all of what you'd expect in a large people business, but it also provides critical infrastructure. And we've been in the habit of designing beautiful built form since 2005. If we just go to the next page, if we think about what Oceania is targeting around its strategy, Internally, we talk about 4 key things: our offer, so what is it that we're here to deliver? Our resident experience, what sort of resident experience do we want to deliver? Do we have the right people to deliver that resident experience? And clearly, being a listed player in a sector that is growing, we have accent towards growth. So that's what you'll see on the left-hand side of the graphic. On the right-hand side, in this market context, we have taken a very prudent and very disciplined approach to our capital allocation. There's well commented headwinds that exist in the New Zealand economy at a macroeconomic level, and we are a business that will build and create great resident experience through the cycle. So we've got a pipeline of brownfield developments. These are where we've got existing sites, and we develop those sites for further optimization and new built form. We've got a bunch of greenfields. This is broad acre, largely land, that we design and build new communities. We've done a bunch of M&A over the last couple of years, and that's been an important part of expanding our portfolio. And also, from time to time, we look at properties within our existing portfolio that don't meet our capital return thresholds, and we divest those assets to smaller buyers that exist within the market context. To put the sector context in frame, there's about 40,000 care beds here in New Zealand, and there's about 50,000 people that live in what we call retirement living. So it's actually been a very active market for buying and selling assets over the last 18 months, putting the headwinds to one side. The other thing that we do is we provide critical services. Our portfolio is weighted towards care, and we have innovated with a product that we call a care suite. So for callers on the line, that's the equivalent to something that looks like an apartment, but it provides care for residents all the way through to hospital level. So it's been an innovation that our peers are now picking up on, and it's been a way of creating a lot of value for our shareholders as the evolution of care in New Zealand has got more and more sophisticated. We have a couple of properties that we're bringing to market in the next period through to our full year, where for the first time we will have the residents paying for the full cost of their care. Traditionally, care businesses here in New Zealand enjoy some funding from government, and the resident often makes a contribution as well. In the case of Oceania, there are a couple of sites that we'll be developing in the future where the resident will be funding their entire care. And what's important about that from my perspective is it solves some of this narrative around equity and access for all New Zealanders. We have a lot of standard beds in our portfolio for those people that may not be able to afford the higher levels of care costs, but we also have those people in communities and higher socioeconomic groups that can afford to fund the larger, or if not their entire funding requirements for care. And that will be part of an innovation that you see Oceania building in the future. If we go to the next slide, very, very topical and something that's really at the heart of what we're doing. When we talk about our growth, we talk about it through the lens of growing sustainably. We entered into a $500 million financing facility recently, and the facility had 3 key measures around our sustainability link line. The first one was obviously awareness of our greenhouse gas emissions. The second was diverting waste away from landfill, so being very diligent in how we think about our built form, being very diligent how we think about food waste, being very diligent how we think about medical waste as it relates to removing waste from our sites. And the last one is an innovation in the sector around resident wellbeing. So this is where we are canvassing views from our residents in terms of how they are thinking about their well-being. So how should you think about Oceania as it relates to its trading performance? We're halfway through our full year. We're a March year end. Our assets have grown pretty significantly over the last couple of years. So we're up from 1.7 billion to $2.5 billion. It goes to my earlier comments around being a provider of critical infrastructure. Our underlying EBITDA, which is a measure of our operating profitability, if you like, is up period on period, and that's been pretty tough with the headwinds which exist. If we think about tight labour markets, if we think about inflation, which is real, affecting some of our inputs, if we think about comments that you would have seen well publicised around the cost of care, you know, we're pretty happy with that result. We can certainly do better, and we can see that the government are starting to take some of those comments to heart around pay parity and some of the issues that have faced the sector. Sales have been relatively strong, and we are seeing that our sales has been impacted to a degree by a cooling housing market here in New Zealand. The sector often looks to the residential housing market as a bit of a signal in terms of how people are selling, how people are thinking about things. Our sales have continued to be successful. It's just the days to sell, so how long it takes us to sell a new product has you know, moved out as people have got used to sort of a circa 15 to 18% potential decline from peaks in the housing market. And part of what we do is an intentional investment around what we call premiumisation of our care. So this is where residents are coming in and buying a room and those services, as opposed to just being traditionally government funded. And you can see on the right hand side that we've had quite a material increase in our premiumisation of our care earnings period on period. Just quickly touching on the last couple of slides. If you think about Oceania, we're a portfolio of a lot of assets. If I could just go to the next slide, please. We're a portfolio of significant assets. We've got about 4,000 residents that we've delivered to date. We've got about 1,800 more units and care suites to build in the coming periods. And we are undertaking a premiumisation of our portfolio. So if we think about the donut charts on the right hand side, down at the bottom you can see how Oceania will be positioned as we build out of our pipeline over the next kind of 5 to 7 years. So 75% or thereabouts of our portfolio will be premium properties. So these are smaller format properties, they're more boutique, they have a smaller residence size, they're built to a higher quality built form, and 25% of our portfolio will be that more standardised product. So this is what you might see in a more provincial or regional setting rather than major cities. We will still offer a significant amount of standardised care beds. We want all New Zealanders to be able to have access into care at a level that they can afford, and that's what you'll see on the left hand side. 25% of our care beds that we have offering to the market will be sort of standard beds that people will be able to afford. If we think about our construction business, which is on the next slide, we have a lot of construction underway. So we are a significant builder on an annualised basis. You can see there that we've got about 10 sites under construction up and down the country. It's about 520 odd units. And it takes a bit of time to build these things. If we think about how long it takes to go through planning, resource, and then construction, it's usually about a 5-year cycle. Waterford we're excited about. That was an M&A acquisition, and we're building some new apartments. The Helier will be a flagship property that we will have coming out of the ground in St Heliers Bay, but we're also doing things provincially and regionally. Woodlands and Motueka is a good example. Redwood in Marlborough is another example of the type of diversity and optionality that we have in our pipeline. Last couple of slides from me before I take questions. We've got a few graphics because we like graphics of our built form. On the left hand side is Waterford. This was a site that we acquired. It came with some free options around land that you can see in highlighted in green. We'll be building some more apartments there, but we'll be also introducing care to the site, and the residents are pretty excited about that. On the right hand side, This was also an acquisition up in Ruakaka, Northland, and we're going through a planning consent change with an option to buy that large parcel of land that you can see highlighted in green, to build out a very vibrant community that wants to live towards Marsden, One Tree Point, and in the warmer climes north of Auckland. So that's in Bream Bay. And the last slide for me is a large greenfield site that we have in Franklin and Pukekohe. This is what used to be market gardens. You can see the residential development that sprung up around the precinct that we own. We're going to be bringing a significant reimagined retirement living environment to Franklin, and our flagship on the right hand side, the Helier, which we launch in March. So that's largely out of the ground. The scaffolding's coming down. That crane that was in the picture has left the site. It is going to be outstanding. It appears from the street as a residential development, but will be delivering the very best in apartment and care, private care living in New Zealand as we develop it in March. So that was a very quick canvassing over the 15 minutes, but I'm certainly open for questions.
Great, thanks, Brent. There are a few questions which have come through from the floor. So one is just around, you've already touched on the sort of housing market and everyone's sort of aware of what's happening in that space, but can you comment maybe on what you're seeing across apartment sales specifically? There is a question around apartment sales, in particular around sort of some of the North Island sites, maybe what you've seen over the last few months in that space.
Yeah, so I think we guided the market in our interim that our new sales was a bit softer than we'd expected. The market almost went to sleep between July and August. If I just think about the housing market, people were aware that the Reserve Bank governor was probably likely to lift official cash rates. People were concerned about mortgages. And so there was a period that the market, I'm talking about the residential property market, sort of cooled. We've seen, what we lost in that first half. We've actually seen reasonably good traction in the second half. So, spring weather has helped. A couple of days ago we hit summer. People are back conditioning themselves to, the new normal around housing. A lot of the product that we deliver in its new form is not necessarily subject to residential housing. If we think about our care suites, people do not move into care suites and necessarily need to sell a residential property. And our apartment sales have gone well. We haven't had to move our price, so we haven't moved our price down. There's always been a affordability gap between sort of residential housing market and what we offer. So we still continue to be price setters for our new apartments and new care suites in the market rather than price takers. And I just think that the market has had a period of cooling as people condition themselves to sort of new settings. Let's not forget that in the last kind of 2 or 3 years, housing markets, particularly in Auckland, have been up sort of 60–65%. So I think we're all breathing a sigh of relief that things might be moderating slightly.
Right, great, thanks. And another question just around the, you mentioned in your presentation the pay parity around nursing. Could you potentially just go into a little bit more detail around what that is, obviously off the back of the recent announcement from the government, and maybe how that in a nutshell affects Oceania?
Yeah, I think that's an excellent question. It's been something that I've been lobbying for a number of years. I sit on the board of the Retirement Village Association and the New Zealand Aged Care Association. I think it's fantastic that the government of today and also cross-party, so other political parties have been involved in thinking about what the response of our sector has been during COVID. We've done incredibly well. Oceania itself, even with its large resident population and weighted towards care, didn't suffer a COVID-related death on its site. So we are very, very grateful for that. But part of that has meant that we need a skilled labour force, and that labour force are nurses, and those nurses globally are in short supply. So being in a situation where some funding may come in to help us pay our staff at appropriate levels is really, really warranted. So pay parity is really recognising that a nurse in an aged residential care setting should be expecting the same or similar wages to a nurse in a hospital setting. They provide the same level of care to elderly, they provide the same services. The government have announced a big ticket number, $200 million. The devil was in the detail, but in essence, from my perspective, it's recognition of the valuable role that we are playing and others in the listed aged care space around providing critical health care. Oceania has a disproportionate amount of nurses. We have about 460 nurses. There's about 4,600 nurses in New Zealand providing services. So if the funding trickles down into wages, then that should be a net positive for Oceania. At this stage, we're still in negotiations with the government as to what the details of that are. But in any event, it is recognition of the validity of the sector, and Oceania in some shape or form should benefit, even if that's around stability of the workforce.
Great. Thanks, Brent. And one last to wrap up. Obviously, over the last sort of 12 months plus, the cost of debt has increased, and typically for a capital-intensive business such as yourself, that makes up a decent chunk of your capital mix. So can you comment on possibly what that'll look like going forward, whether it's sort of changing in your view and in the view of the board in terms of how you fund either developments or acquisitions? Yeah, and just the sort of changing environment we're in that space with the interest rate rises we're currently seeing.
Yeah, I think that's an excellent question. The first comment that I'd make is that Oceania undertook about 18 months ago to fortify its balance sheet to put the company in a really, really strong footing for this future period of growth. We raised capital when we were travelling at a premium to our net tangible assets to fund some acquisitions and to repay debt. We extended our facilities by $150 million and locked them in for a longer duration. So, 5 years from now. We also came to the market with two bond issues, 100 million and 125 million. Both of those were done at fantastically low interest rates, and they were locked in for 7 years. So we diversified the funding. We got ourselves set for providing the very best balance sheet strength over this kind of next period. And some of that was good luck, but some of it was intentional design about we were accenting towards growth, and we wanted to have surety of our funding costs going forward. The other thing that Oceania does is traditionally we've entered into fixed price contracts for our build, and as a consequence of that, of those 519 units that I talked about before in the 10 sites, they are all fixed price contracts. So we know what our inputs around build costs are, regardless of the real supply chain and inflation pressures that are in the economy. So over this next period, we're feeling really good about our funding sources, about the diversity, about the cost. But if we look at our business cases going forward, we're very mindful that the risk-free rate has gone up. We've always imposed a very high hurdle rate for projects, and we try to secure about 1.3 times cash recovery on any new build. And you can see that reflected in our development margin. So we traditionally have been running with a development margin of about 30%. So when we build a building from those first time sales, that's what we're trying to recover in cash. I think that'll get harder as we go forward, but at least for the next couple of years, we've got a pretty firm foundation. We also err on the side of conservatism as it relates to our gearing. We keep our gearing in the kind of 35% range. We're at a bit of a peak debt flow period at the moment, but yeah, we're very conservative in terms of how we think about the use of our balance sheet.
Great, thanks, Brendan. One last quick question that's come through, which should be a straightforward one to answer, hopefully, is just a question around the entry age for Oceania retirement villages compared to other listed retirement villages. Are they all similar, or is there a difference in terms of where Oceania sits?
I think we are pretty similar, to be honest. Oceania has traditionally had an older population, so our entry age for independent living is 70 years of age. Our average age of population is about 83.6 years of age. And I've met a lot of our residents, and they all look in their 60s, to be honest. People have looked after themselves well, so we've got a higher average age than probably some of our peers, but our entry age criteria are pretty similar, I think, across the board.
Great, thanks very much for your time, Brent. Really appreciate you taking time out of your day to present for us, and all the best for what's left of the year.
Yeah, thanks everybody for joining the call. Appreciate it.
And we're now going to welcome in Dr. Hartley Atkinson from AFT Pharmaceuticals. Hartley founded AFT in 1997. There they are. Welcome in, Hartley, and Malcolm's there as well as CFO at AFT. So yeah, Hartley founded AFT in 1997, as just outlined, and has got a fairly extensive background across pharmaceuticals and pharmacy. I could list through all of the qualifications, but the doctor at the start of the name probably says it all. Really interesting space to be in, I suppose, sort of linked in with what Brent was just talking about in terms of demographic shifts and the need for really good operators in this space. So Hartley and Malcolm, I will hand over to you guys and be back shortly.
I'd just like to run through some slides to give you an update on where AFT Pharmaceuticals is at. So this is primarily around our first half results, but just also to explain about the progress that we're making. So just to flick onto the next slide, please, Malcolm. So look, standard disclaimer, please just take this as read and read it if needed. And move on to the next slide. Look, so this is just a kind of introduction of our progress. As you can see on that graph on the bottom, we've never had a down year in terms of sales. Literally every year since we have been in existence, we've grown sales year on year. And what we're working on at the moment actually is to pick this up, or pick the pace up. There was a general on the suggestion from quite a lot of analysts and people that during the COVID time, somehow this was a tailwind and helpful for us. Obviously, we've seen other companies like Fisher & Paykel Healthcare where it was clearly helpful. For us, really, it wasn't helpful. If anything, it made things much more difficult to launch new products. It restricted access of patients to pharmacies, to doctors. So really, we're really noticing now COVID is starting to recede. It is much easier for us to do business, and we're seeing sales accelerating. This year, this first half, we had an 18% increase in revenue. But look, we'll cover this more in some of the slides. It's just important to break down what that really means, because we do have a lumpy element in our sales as well. And you can see, look, in the middle part here, we just look at our three main areas. We have Australasia, which is Australia and New Zealand. Our main market is Australia, where we have some 150 or so products sold across 6,800 pharmacies. Asia, we have a building business, which is really in an infancy stage, and rest of the world is anywhere outside Asia Pacific, where we have mainly our drug development pipeline, our R&D pipeline. We're selling that through licensees and distributors, and we have agreements in more than 100 territories, and we're basically spreading out our sales over time. Malcolm, next slide, please. So yeah, look, in terms of what the highlights were and what we're seeing is we grew our sales by 18% or so. This though, we do have some lumpy licensing income, which is quite difficult in some ways to explain, and that it depends on various timelines of things like registrations. So what we're doing going forward is we have had some feedback, and we're like breaking this down now to start talking about business as usual, sales targets, and then licensing income as a second line. If we take licensing income out, which is probably a better way to look at the business, our actual product sales and royalties grew by 30%. So certainly we had strong business as usual growth across all our key areas. You can see revenue by region on the bottom left graph, where Asia is the smallest part of our pie presently, then rest of world, then New Zealand, then Australia is our largest market. And same, you can see the pie graph and also the operating profit on the far right. What we should just point out is that last year, especially in the first half, we did have quite a lot of licensing income, which was basically around about $4 million or more. So if we back the licensing income out, our profit actually grew nicely in the first half, but we did again have this lumpy licensing income did impact on the first half profit. So flicking to the next slide, Malcolm. So look, Australia, as I've said, is our key market. We see a lot of growth potential in Australia going forward. And very much the way we work, we really are in many ways an Australian company that happens to sit in Takapuna, where we work from, but most of our business decisions are all based on looking at the Australian market and then building things out from there, but also, you know, obviously selling in New Zealand as well. But there are a lot of advantages, like we have trans-Tasman stock and things like that, where you can shift stock between the two countries, and you get a lot of synergies between Australia and New Zealand. But it's just important, we can never forget Australia is our main market, and that's where a lot of our focus is. You can see, look, we're getting reasonable growth. It's up 24%, but we see, you know, potential for greater growth going forward. We've got very good, nice growth out of our OTC channel, growing at almost 37%. And you can see, if you look at the pie graph, the business is kind of split into three key areas, being OTC, RX or prescription, and hospital business. And we saw, you know, with our good growth in our OTC business, we saw that making up now 66% of our Australian business. One of the nice things about OTC business is that there is a lot of people have talked about it, pricing changes, inflationary pressures, and certainly with OTC, you've got you know, potential to change pricing reasonably quickly, where things like the government business, which is primarily RX and hospital, do take longer to make any you know, adjustments that are needed. So flicking on to New Zealand, yeah, we had a really good result in New Zealand, which is very pleasing. We had 35% sales growth, which is pretty much actually organic sales growth. We really saw a bounce back after a lot of the restrictions with COVID, you know, the last 2 years. So we really saw significant growth in the New Zealand business. And going forward, we do see ongoing growth potential, more than what we had previously thought. And we have a lot of new products to launch. Typically, we launch the new products in Australia first, and then we roll them across the Tasman to the New Zealand market. So we do also have a lot of new launches in New Zealand coming up over the next 2 or 3 years as well, which should help to further drive our sales growth on top of our existing organic sales growth. So flicking to the next slide. Yeah, look, this is just to give you a bit of a flavour for what we're talking about, new launches. Literally over a 3-year period, you know, we've got over 70 products that we're launching. You can see we've split these down into, over a couple of years, into half-year periods. We've got a big last half of the year. We have 15 launches across Australia and New Zealand, primarily Australia actually, and 14 of those are OTC products, which do require quite a lot of work. So we're going to have a very busy last half of this year. And certainly this is the key thing around our growth. We're getting both organic growth generally, but also as we expand and broaden our pipeline, then that also helps to drive growth as well. So that's the next slide, please, Malcolm. Looking at Asia as well. So this basically, we define this as, you know, the main Asian area, which goes right up to through Southeast Asia and up to Northern Asia, which is right up to Korea, potentially Japan. We don't have any sales there yet, and also China as well. So basically, we're getting about a 26% sales growth in the Asian market at the moment, but we do see a lot of potential going forward. Most of the sales presently are hospital sales, which are usually easier and quicker to get, but we're also working hard on building our OTC sales, and we're doing a bit of work at the moment, especially in Singapore with McPherson's, where we switched around our local distributors and sales teams, and we're certainly getting good growth of Maxigesic product in Singapore, but also good growth in Malaysia and Hong Kong as well. One of our main things we're working on, just quietly really, is our e-commerce platform through Tmall. We actually have a good chunk of products approved, about 15 approved on the Tmall site. Things in China, though, are very restricted presently, as you would have read, due to COVID restrictions, and that really is impacting and hindering our expansion of our e-commerce platform. Having said that, though, we're still pleased they make up about 5% of our Asian sales, and when they have events like 11/11, it's getting up on a, you know, the annualized and monthly sales is getting up to around about 10%. So we do see potential going forward, especially for the e-commerce platform, as things ease up in China, which we believe they will. They can only keep things restricted for so long. The population's getting very unhappy with that as time goes forward. So that's really a major upside that we're working on as well. Next slide, please, Malcolm. So on the international business, that did appear to be down, which it was, because we include licensing income. If we include just product sales, we got about 68% growth in terms of product sales and royalties. Licensing income, as I've mentioned, is lumpy, so we did have a big chunk of licensing income last year, but overall the product sales are growing. Number of countries are growing too. Last year we were selling in about 46 countries. This year we're targeting 63, and the year after 73, and we still have some way to go to get to 100 plus countries, which is what our target is. And also we haven't started yet in sort of really large markets like the United States, and clearly that's a key target market, being the largest pharma market in the world. So that's international. And next slide, Malcolm. Look, just quickly, this is our kind of global map that we show people and how we track things. White is where we haven't yet done anything. Blue is where we have an agreement and we're still working on registration or something like that. And yellow is where we've launched. So actually, the map is changing. We're getting more yellow going forward, which is good. We just launched in Indonesia recently with Maxigesic IV, so that's certainly turned to yellow. Still working on agreements in some quite major countries like Japan, China, and Brazil. These are quite tricky jurisdictions, so it may still take a while, but certainly that's our aim. Markets like India, to be frank, we're not targeting that, so that will remain a territory in white going forward. Next slide, please, Malcolm. The other important thing is R&D. We conduct our own R&D, and it's pretty important. We have a clinical research department. We run our own clinical studies. A lot of smaller biotech companies might raise money from the market, and then they go to what's called a CRO, and it's actually, we don't do that. We run our own study working with the doctors direct in places like the United States. We've just finished a 16-site study around the world, going from Australia, New Zealand, up to Taiwan, up to 6 sites in the US, and the balance of the sites across Europe going out to Serbia. So we do have that ability, and that's quite important. What we've seen at the moment is there are good opportunities around the world where a lot of smaller companies with some good technology are not able to raise capital. So we've taken advantage of that and done a few deals where we've padded out our portfolio because we are profitable with funding our R&D out of profits. So we see there's quite a lot of really positive upside for padding out our portfolio. So going forward, we can complete these drug developments and then feed them into our international business. And in fact, a lot of our current customers in Europe, etc., are saying, hey, we like what you're doing. What else have you people got? Because we want more products from you. We want to deepen our business relationship with you. One of the products that we did recently was strawberry birthmark treatment. We did an agreement with Massey University for them, and that is under development at the moment at Gillies Mackinac. We're doing the first stage of the R&D in conjunction with them, and once we've done further work on that, we would then move into manufacturing and then into the clinical side. So this is quite an early phase project, but it is a really nice project. Involves children with strawberry birthmarks, you know, which obviously has a major cosmetic and can be worse as well. Impact, the current treatment is an oral treatment that is only reserved for very serious cases because it can be potentially toxic. So this is an example of a nice sort of project that AFT can tackle and apply what we've already learned. We do have a number of projects. We have the NZX, which is involved in its first human study presently, and we did do market research. We're targeting what potentially is $1 billion market opportunity. Then we do have a number of other projects which have got code names on them. That project BT, the third one down, that was another example where we acquired that off a company in Europe that was in a bit of financial strife, and literally we were able to get the global rights for a very advanced project, probably for about $500,000, you know, maybe 600 grand or something, which really was an excellent opportunity. And once again, this is the sort of thing we're funding out of profits. So we do have a number of other projects too on the far right. We are looking at the moment at one further project, going through diligence on that. So, you know, the R&D side is pretty important, and we see that as a major opportunity going forward. Maybe just to really quickly flick on maybe one or two finance slides of Malcolm first, and then we can get to the summary page and leave time for questions. Thank you, Malcolm.
Thanks, Hartley. Yeah, I think the slide we're on, the operating profit, is probably the most important. So on the top line, we can see the growth in revenue up to just under 66 million. And actually, if you go to the bottom of the slide, you can see what the product sales, 30% product sales were there from the previous year. And the reason we've done that is to show you the gross profit. So again, at the bottom of the slide here, you can see we've held the margin at about 43, 44%. And then moving back up onto the main table, the operating profit of 3.4. If you back the 4.8 million out of the 5.5 from last year, we made $750,000 last year without the license income, and then 3.5 this year. So they're probably the main features on that slide. Cash flow. Oh, did it change? Yep. So 6 mil from the operating activities. The 4.8 investing. So that's R&D. Is the bulk of that. That's about just over 3 mil. And then the rest is money that we're spending on IP, so patents, trademarks, that sort of thing.
We are sort of looking at funding R&D going forward for the next few years at about 12 million a year. We can look to increase that maybe in future, but presently with the projects we got, we see around about 12 mil is kind of enough for what we need to be able to do.
12 million cash, yeah. And then the finance activities, that 3 million is interest, and we've paid back 2 million of the loan with the BNZ. So that brings us onto the balance sheet. So net debt still in that sort of 29 million range from the year end, down from 33 the same time last year. We have just renewed the facility with the BNZ for another 3 years and 5 months. So that takes it out to April 26. They're probably the main features here.
Sure. So to flick on, look, just to sum up with the outlook. Yeah, look, basically, we've always traditionally had a stronger second half. We're sort of at a sales split normally ends up being about 40% in the first half and 60% in the second half. So we're seeing similar kind of this year. If anything, maybe more skewed because we have a lot of those product launches in the second half in our main Australian market. What sort of has happened though is that we did look at it carefully, that with our strong product growth and a lot of OTC products, we did see that we wanted to increase our investment over the second half. As a result of that, that has pulled down our original guidance. But it's really primarily around, there's a couple of things. One was the timing of licensing income for our United States Maxigesic IV project, which is sort of some $3 or $4 million. But then also there was an additional, I was spending probably up to an additional 10 million this year on product promotion. We are seeing some good sales growth, and we really see long-term, thinking long-term makes a lot of sense to really keep our foot on the pedal, even though it does have a bit of an impact on this year's profit, but we see that as positive going forward, and we are really thinking long-term. But still, you know, we are able to spend quite a lot more money and still turn in a decent profit. So basically, we are forecasting now, and we're splitting it out at 17.5 to 21 million from business as usual, and then with licensing income, there's a further $500,000 to 2 million from business as usual licensing income. We do have quite a lot of agreements where we have smaller amounts, like $250,000 or something, or 100 grand or something like that. Those all add up to form this sort of income here. We've really looked at large chunks like the chunky bit, which is about 6 million from the IV deal, and we decided at this stage not to include that in the profit forecast. So our target as well, we've said, is to exceed 200 million of annual sales in the near future. Yeah, look, when we say near future, we don't mean 5 years, but we're sort of a bit reticent to put an exact date because it may move around 3 to 6 months, but really it is something we see in the kind of near future as well. We are confident in achieving our originally budgeted licensing income with the Maxigesic IV in the US. And then the other important thing is we don't see any of this changes our intent presently to declare a maiden dividend for the 2023 financial year as well. A lot of investors have asked us when we met them and said, you know, what's the story? Are you planning a dividend? And just to reconfirm, the answer is yes, we are. It's not going to be a huge chunk of profits. We previously said 20 to 30%, because we do see a lot of opportunity for growth. We do want to keep investing strongly, but we see sort of starting to pay some sort of, you know, modest dividend, and then growing the top line, growing the profit, and that dividend will then grow is our plan off the back of that. So look, thank you very much for your attention, and happy to try and answer any questions that you may have.
Great, thanks Malcolm and Hartley for the presentation. We do have a few questions that have come through. First off, you've kind of covered off in a fair amount of detail the obviously investment that you do and the importance of R&D in terms of the sector that you're operating in. in terms of protecting that investment going forward, obviously patents are an important part of that. And there's a question just around the sort of geographic split, I suppose, of the patents that you have. So where some of those lie, and I suppose the process that you have to go through to acquire those, and maybe whether, you know, you talked about acquisition opportunities, whether those come with those opportunities, or yeah, I suppose just providing some colour to that.
Yeah, sure. So look, we have a pretty broad approach to patents. So we literally file in most countries. So we'll go right across, even Africa, South America, Latin America, obviously the main chunks like the US, Europe, etc. But you know, right throughout Asia as well, like Indonesia, Korea, etc. So we have a very broad approach to patenting. It's not narrow, and that's quite important because we do see there's good potential for markets outside the main kind of European Western markets. So that's important. We are big trade markers as well. I mean, for example, we were told at one stage, I think we're the 3rd biggest trade marker in New Zealand after Fonterra and Fisher & Paykel Healthcare. You know, so we do a lot of trademarking, which is also part of the IP as well. When we do a drug development deal, like say with Massey University, they did have a patent granted, and then there was going to be filing in what's called the PCT, where you go around the whole world. So literally part of the deal is we do acquire rights to that patent, and we then get involved in the patent prosecution in the different jurisdictions. So that is really a key part of our business, is getting that IP across as many jurisdictions as possible.
Great, thanks very much. Next up, there's just a question around the US market in particular. Obviously, the overarching theme there is probably FDA approvals in terms of being able to get into that market. But do you see the product mix changing, or is there a product mix that's specific to that market or specific opportunities, I suppose? The one you've already spoken about is Maxigesic IV, but is there anything else in that space that's unique to the US market?
Yeah, we've got two pending approvals presently. So we have Maxigesic rapid tablets, and they have a granted patent until 2039. We're expecting approval of that next year. And then we also have Maxigesic IV, or intravenous, and that currently is licensed to Hikma Corporation, which is one of the major suppliers of injectables to US hospitals. And we were hoping to get approval this year, but we have one final question, only one from US FDA, around something called extractable leachables. And we are working on that presently, and all going well, we'd anticipate regulatory approval probably about next October in the United States, which would enable launch next financial year. So those are the two we're working on presently, but you know, we have other projects in the US. I think almost always has to be part of one's commercialization strategy, given it's the largest pharma market in the world.
Perfect. A couple more from the floor. So one just around topical areas, obviously ESG. Can you comment on any framework that you've started to apply in that area? I know there's a number of reporting requirements that are starting to come in there, but can you speak to what your ESG sort of framework that you work against is?
Yeah, sure. Look, Malcolm's working most closely on that, but that's clearly something that we're pretty heavily involved in. Malcolm, do you want to maybe summarise briefly what we're doing in that area?
Yes, look, around ESG, really, when we started the company in '97, our mission pretty much from there is, and that's a strap line that we've always put on, is working to improve your health, you know, which is strong in particularly in the social area, governance area. It's a highly regulated industry that we're in. All the drugs need to be approved by the regulator. And then, of course, you've got the wider governance around diversity. We have around about, of the 100 staff, I think it's about 24 different birth countries that we've got. We're probably slightly skewed towards female, which isn't untypical of this industry. And then, of course, we've got all the other compliance side of governance.
Yeah, things like modern slavery, because we're over $100 million business, we're required to report that to our Australian customers. So certainly that's something that we're well across, and we've completed that project. I mean, we personally visited most of their manufacturing sites as well, and as Malcolm says, it is a pretty regulated industry as well anyway. So yeah, we certainly covered off things like that are important to us, obviously.
Perfect. And one last question is just around your kind of capital structure. The question specifically is around when you expect to pay off the debt that you have on your balance sheet, but maybe sort of broader question similar to what we talked about with Brent in terms of the changing interest rate environment and the increasing cost of leverage, and just maybe how that's playing into the decision making at a management and a board level for capital structure.
I mean, maybe Malcolm could talk most of it. I mean, just from our side, we originally had fairly expensive debt, which we had when we floated from CRG in the United States. So we did pay that down, and we're now working on much lower cost of capital. I mean, we're pretty comfortable having some debt around that working capital level. I mean, Malcolm, do you want to comment maybe further on that?
I think you summarised it well there. That's it really. So we're targeting to keep net debt at around about the same as EBITDA. 1x EBITDA is where our goal is. So we're sitting slightly over that at the minute, but we can see it coming down. And yes, Hartley says we're quite comfortable to have working capital. With the amount of money we've got tied up with inventory and debtors, we're comfortable having fairly cheap debt there from a commercial bank.
I mean, we have almost tried to be fairly counter-cyclical, where we paid down our debt a while ago with expensive debt, when times were good. And to be honest, now times are supposedly bad, which doesn't impact pharma sales keep going. We actually have been shopping. That's why we've done so much in licensing, and we picked up a couple of R&D projects, because our strong belief is that our profits don't disappear if economic times worsen, because people still keep taking their medicines, really. So that's our sort of approach, is slightly counter-cyclical.
Perfect. Great. Thanks very much, Malcolm and Hartley, for presenting today, and all the best for the rest of the year, and we will be in touch in the new year.
Thank you very much. Thank you, everyone.
Great, and that concludes the webinar for today. Today's webinar was the last one for 2022, so thank you for everyone for joining in. As always, this recording will be available on YouTube within the next 24 hours. But aside from that, thank you very much for joining, and we will see you next year back on the virtual investor events.